Your EMIs may fall, your mutual fund returns may change, and RBI just injected 1 lakh crore into the system. But nobody is explaining what this really means for you. So, in the next few minutes, I will be breaking down the RBI decision in the simplest way possible. No jargon, no confusion, only clarity. And if you are new here, welcome to Insider Monk, where finance becomes simple and profitable for everyone. So, what did RBI do today? RBI cut the repo rate by 25 basis points. That is from 5.5% to 5.25%. So, MPC decision was unanimous. Now, RBI expects the GDP growth of 7.3% in financial year 26. RBI has also announced a massive 1 lakh crore liquidity boost through open market operations and a $5 billion forex swap. So, the simple summary is money has just gotten cheaper, liquidity has just increased, and the economy is getting a strong push. Now, the question that arises is why did RBI cut the rate? So, inflation is very low right now. Economic growth is solid. Globally, rate cycle is softening. Credit growth also needs support, and liquidity in the banks was getting tight. So, RBI has basically opened the tap and said, let the economy breathe. So, will your EMI reduce? Short answer is yes, but not immediately for everyone. Now, if your loan is linked to the repo rate, EMI will reduce in 1 to 3 months. If your loan is MCLR based, then the reduction would be slower. For new home, car, personal loans, they are becoming cheaper instantly. So, you should comment below with home loan if you want me to calculate your new EMI in the next video. Now, what is the big impact on mutual funds? So, debt funds, they are the big winners. When the rates fall, the bond prices rise and the NAV jumps. So, the best positioned funds are gilt funds and long duration funds. For liquid and ultra short funds, yields may soften slightly, but stability remains high. For hybrid funds, debt side benefits. Equity sentiment also improves. For equity market, lower rates means companies borrow cheaper. So better earnings outlook that will create a positive liquidity sentiment and foreign investors will be attracted. So the biggest impact will be on the SIP investors and not how you think. Now for SIP investors, the rate cuts are not for timing the market. They are for strengthening your SIP returns over the next 2-3 years. So lower rates means higher equity inflows, debt market gains improve, hybrid stability, and the volatility reduces. Now, what about FD investors? FD rates may drop in the next 1 to 2 months. So, what would be the best strategy? Lock your current FD rates if you are conservative and move part to short term debt funds for better tax adjusted returns. Now, this is my understanding. You might have a different opinion here. So, what is the 1 lakh crore liquidity move means? So banks are getting easier access to money. Now this will lead to lower borrowing costs across the system. This will help the NBFCs, housing financiers, and MSMEs. This will prevent the tight liquidity condition, and this will support the currency stability indirectly. So RBI has basically ensured that banks don't run dry, so credit keeps flowing. So what you should do now? You should continue your SIPs. Debt investors can allocate slightly longer durations. If you're thinking of a new home loan, then it's a great time. For FD investors, you should lock the rates and you should avoid panic selling in both equity or debt. So if you found this helpful, hit subscribe. I will break down every complex financial news into simple profitable insights. And don't forget to share the video with someone confused about the RBI move today. See you in the next one. Thank you.